Hello, welcome to AOBA's webinar on CPACE financing today. My name is Peggy Jeffers. I'm the Executive Vice President for AOBA, and we're really pleased to bring to you this subject matter that we've gotten various inquiries about. This is a program or a financing mechanism that's been around for a while, since 2009, but it's gone through various iterations, and given the need to access capital these days, it's particularly relevant today. So DC has authorizing legislation and is an active market for CPACE financing. It's my pleasure to introduce to you today Mary Thomas, the Associate Director for the Building Innovation Hub, which is an initiative of the Institute for Market Transformation. Mary has put together an outstanding panel today that will explain what CPACE funding is all about, and actually take you through an example of someone who's actually gone through this process. And then we will open it up to Q&A for folks. If you do have questions, please put them in the chat if you'd like to, or hold them till the end when we will have a chance to address them. Everyone's on mute, and we ask that you just hold your questions until the end of the presentations. Okay, and with that, I turn it over to Mary Thomas, who will introduce the panel.
All right, thank you, Peggy. I'm going to share my screen now, so just give me one moment. Okay, so hello, everyone. Thank you so much for having us here today to talk about PACE financing, an alternative financing program for your energy efficiency projects. My name is Mary Thomas, and I'm an Associate Director of the Building Innovation Hub, also called the Hub, which is a program of the national nonprofit called the Institute for Market Transformation, or IMT. And I'm excited to be here with a wealth of experience in PACE financing. We have a PACE administrator, a capital provider, and a building owner, and I'll let them introduce themselves, starting with Ronald.
Good afternoon, everyone. My name is Ronald Hobson. I am the director of the DC PACE program with the DC Green Bank.
I'm Lisa Nordell, Senior Vice President of PACE Operations for Peachtree Group, formerly known as Stonehill PACE.
Good afternoon. I am Kelly Brooks with Urban Atlantic. I'm a Managing Director of Finance for Urban.
Okay, thanks, everyone. So here's our run of show for today's session. And since PACE is a program that can be used to finance some building energy performance standard projects, I'll give a high-level overview of the BEPS. Ronald will provide background and insight on the DC PACE program, and Lisa will zoom out for a snapshot of PACE across the country, then dive into the details of the PACE application process and loan structure. And Kelly will share her experience with PACE from the building owner's perspective and share a case study. And finally, we'll wrap up with a moderated discussion and audience Q&A. And at that time, we'll invite folks to turn their videos on and unmute themselves. And we'll also be monitoring the chat for questions. So before we begin, I wanted to, first of all, take a minute to introduce the Building Innovation Hub. And as mentioned, we're a program of the national nonprofit known as IMT, which sits in the middle space between government and the private sector on climate policy and implementation. And the hub was created in part to support the buildings in the DC area implement sustainable building policies like BEPS with education, outreach, resources, and connections. We try to meet everyone where they're at while simultaneously pushing the sector towards the innovative solutions needed to have high performance buildings. And we create resources, convene meetings, give presentations, and organize events like this webinar on PACE financing to equip you with what you need to be successful and make it easier to act. And now I'll get into an overview of the BEPS. Well, I'm sure many people here know the district has ambitious goals to reduce greenhouse gas emissions, and because buildings account for over 70% of the district's emissions, reducing the amount of energy used in buildings is a key way to get there. The Building Energy Performance Standards, or BEPS, were created as a mechanism for reducing building energy usage and ultimately citywide carbon emissions. And buildings can, I think we all know, reduce energy usage through a number of means, including energy efficiency upgrades, which can be eligible for financing through PACE, as you'll hear from our panel of experts. And DC Green Bank and the Hub are here to help with meeting those goals in a variety of ways. Maryland also has climate commitments and is in the process of drafting its BEPS regulations. The regulations were presented in September and are available for review on MDE's website. And there will be a formal public comment period later this year. Montgomery County also has a BEPS, and they're working on their regulations and should have something out by the end of the year. Buildings in Montgomery County will have to comply with both the county and the state BEPS, and there's a coordination effort underway between the county and the state. We're here talking about PACE, so I did want to note that Maryland has a PACE program to help finance associated building upgrades in eligible counties, and Montgomery County and Prince George's County also administer their own PACE programs. And while Virginia doesn't have a BEPS, there is a Virginia PACE program as well. So zooming out, I wanted to highlight that BEPS are not just in our local region. This map shows cities, counties, and states that have signed on to the National BPS Coalition, which means they have committed to adopting BPS legislation by Earth Day 2024. There are now 45 jurisdictions that have signed on and are actively working on building performance standards. And BEPS has different requirements in different jurisdictions. And so I'm going to take a brief dive into the BEPS in DC, since it was the first BEPS and we're in the middle of the first cycle. The DC BEPS is based on a median approach. Under BEPS, the district aggregates individual building performance information by property type and establishes a standard based on the median for that building type to meet. Half of the buildings are compliant and half need to make improvements to come into compliance. These standards are based on and measured against a building's demonstrated energy performance, as shown in their benchmarking data. And if your building is performing better than the median for multifamily housing, for instance, you are not required to take action under this BEPS cycle. But buildings that do not meet the standard for their property type are required to improve their performance over the course of a compliance cycle and demonstrate their accomplishments at the end of the cycle. So who do BEPS and benchmarking apply to? BEPS have a size-based timeline, and in the district, large building owners, over 50,000 square feet, have been benchmarking their energy and water performance for a decade. Buildings 25,000 square feet and up started benchmarking 2 years ago in 2021. And this first cycle of BEPS, which is the cycle we're in right now, affects buildings 50,000 square feet and larger. And each progressive cycle will include smaller buildings, as you can see here. The current cycle affects over 1,600 buildings, half of which need to improve performance. And in future cycles, this number jumps to over 5,000 buildings in DC as the size threshold drops. PACE financing can help with these building improvements needed for many of these buildings. So my last slide on the BEPS, here's a timeline where you can visualize how everything comes together in a cycle. The first compliance cycle started 2 years ago in 2021, and by the end of the compliance cycle on December 31st, 2026, underperforming buildings will have to improve their performance, as well as provide benchmarking data to prove compliance. That means that any retrofit measures will need to be completed by the end of 2025 to have a full year of benchmarking data by the end of the compliance cycle. It's important to note that the district will then reevaluate aggregated building performance after the first compliance cycle and likely raise the level of performance for the next cycle of BEPS in order to meet the district's climate goals. So buildings that are currently meeting the BEPS in this cycle may need to make improvements for the next one, which is why we are broadly advertising what's going on with the BEPS, even if the current BEPS cycle is not something one of your buildings is impacted by. So operational and energy efficiency improvements are the key to how buildings comply with BEPS. And as we've mentioned, PACE financing is one way to move forward with your energy efficiency projects. So I'll turn it over to Ronald to explain more about PACE. So Ronald.
Okay. Thank you, Mary. One of the bold initiatives that came out of the Mayor's Climate Action Plan was the creation of a green bank in which DC Green Bank was established through statute 5 years ago, the DC Green Bank was created as a quasi-governmental entity to use public dollars to crowd in private financing to ensure that the future of DC is clean, renewable, affordable, and inclusive, reaching every corner of the district. When we talk about a green bank or DC Green Bank, the first question we often receive is, what is a green bank? To the answer the question, it helps to say what green banks are not. We're not deposit institutions. We don't take deposits, or we don't have consumer line of credits. We simply invest in community development projects. In short, we are a mission-driven financial institution that invests in sustainability-related sectors to pursue collective climate, energy, resilient, public health, and economic development goals. As an investment fund to achieve our mission, DC Green Bank has two ways to develop financial solutions to district commercial property owners. First, through our direct financing with our DCGB investment team, and secondly, through the DC Property Assessed and Clean Energy Program, also known as DC PACE, which is what we'll talk about. PACE is a Department of Energy inspired financing model that is designed for governmental entities like the district to work with private capital firms in a public-private partnership to allow commercial property owners to finance energy efficiency upgrades, water conservation measures, or renewable energy installations in existing or new construction of commercial properties. The local banks and national non-bank financial institutions provide the required capital for PACE projects, and the local authority performs the payment collection through a special tax assessment. DC PACE was formed in 2013 under the Department of Energy and Environment, with Urban Ingenuity initially managing the program as a contractor. In 2021, DC Green Bank took over the program as the administrator on behalf of the district government. DC PACE is managed by myself and my colleague, Natrabo Douglas, who is also the DC PACE coordinator. PACE is like any other loan, but it's purely based on energy efficiency. It's unique in the sense that DC PACE financing allows for the loan to be repaid over longer periods of time through this tax assessment. And in the district, it's repaid every 6 months on March 31st and September 15th, unlike traditional banks where you pay the loan monthly. We currently have 24 capital providers in the program that can provide loans to meet your financing needs. PACE financing can support projects that can reduce operating expenses, increase your property value, and increase cash flow with minimal upfront costs. We can finance up to 100% of the project costs, covering hard and soft costs, including capitalized interest and closing fees. In fact, this financing can be structured as an off-balance sheet item because it is a special tax assessment, and the PACE note remains with the property even after a change in ownership. PACE can also be an attractive financing vehicle to replace expensive mezzanine financing in a capital stack. Some of the other unique benefits is that PACE is designed to be a cash neutral investment, meaning that your savings have to be greater than your investment. And we measure that through a savings to investment ratio, which has to be greater than 1. I should note that when you're looking at your forecasting models on energy savings, you should also factor in consideration increases in future utility costs to ensure that you're making the right decision. One of the other benefits of PACE is that the long-term financing terms with traditional banks, banks may go up to terms of 5 to 7 years on equipment financing purchases, while PACE can go up to 30%. I mean, not 30%, 30 years. And PACE does not require personal guarantee, unlike traditional banks. Also, with rising interest rates, PACE has become an attractive financing tool in this capital stack, where mezzanine financing can go up to 17% and above. Traditional base financing can run anywhere from 7 to 9%. And I'll let Lisa speak to the rates. We are currently seeing a lot of requests for the reason that of the rising interest rate, particularly within the hotel industry. Next slide. Outlined are the types of projects we finance. We finance almost anything tied to an energy or savings, water savings. We do not finance natural gas installations. We finance a number of multi-family units, office building, churches, other nonprofits, retail shops, condominiums, a co-op, and a stadium. Next slide. To qualify for the PACE program, your property must be located in the district. You're current on your taxes, have not defaulted or filed bankruptcy within the past 3 years. Other eligible criteria include multifamily properties must have more than 5 units. We often get requests for 4 units. We wish we could do 4 units, but right now that with regulations, we can only do 5 units or more. We do not finance residential properties. In addition, you should also have a tax ID number and SSL number associated with your property, and that the property that you're current on your mortgage. Next slide. It takes about 3 to 4 weeks to obtain an approval for a PACE loan. That is, once we receive all of the required documentation from a capital provider. The mayor does sign the note, and then you will also need to sign a tri-party agreement with the district and capital provider at closing. Next slide, please. Here are some of the key financial ratios we require before be met before approving a loan. These key covenants are in our program, outlined in our program guidelines. I should also note that because PACE is a special tax assessment, we do require lender consent to sign a consent form acknowledging that we have a first lien right to the property. Some lenders may object to this because they do not want anyone come ahead of them when it comes to their lien priority. However, more banks are becoming more comfortable with this as we educate them on the overall risk, and particularly as they lose market share to PACE lenders. We do have some lenders that I can say that have provided lender consent. Banks like Forbright Bank, John Marshall Bank, City First Bank, Eagle Bank, and Green Lake Bank, which are some of the few banks that have provided lender consent. Also, some lenders may require an escrow agreement in order to ensure that the PACE loan is paid as a way to provide lender consent. Next slide. We're very excited to announce that since the inception of the DC PACE program more than 10 years ago, we've exceeded the $100 million mark this year. We've generated over $48 million in PACE loans since the DC Green Bank took over the program in 2021. We produced $28 million in PACE loans this year. And as you can see, PACE has become an attractive vehicle to help you meet your project needs. We've done a total of 51 deals in every ward in the district. Next slide, please. We've highlighted some of the projects we've done in the past, most notably Audi Field, the home of DC United soccer team. That was a $25 million PACE deal where they did solar, high efficiency HVAC, LED lighting, building insulation, stormwater, and green roofing. In Ward 6, one of the PACE loans that was near and dear to my heart was the 1966 9th and a half Street project, the building that houses the African American Civil War Museum. It's the museum where my great-grandfather name is inscribed on the wall. That project was, the capital provider was Peachtree Group Credit. And we've done small deals. A small 3-story multifamily unit in Ward 8, $380,000. I should point out that we can provide loans as low as $100,000. Our statutory limit is $250 million, and we're currently at $104 million. So we have plenty of room to assist property owners in providing PACE loans. I should also point out that because the number of community banks are on the decline due to bank acquisitions and tighter regulations on new bank startups, it's becoming increasingly difficult to get capital to do smaller deals. There has been some talk of creating a PACE Express loan program or adding CDFIs as a capital provider to address this issue, but there's still a lot of discussion going on with that. I will end my presentation by saying that the DC Green Bank and the DC PACE program are open for business, and we look forward to working with you on your green energy projects.
All right, well, thank you, Ronald. So now we'll hear from Lisa to get into more detail from the capital provider's perspective.
Sure, thank you, Mary. Peachtree Group Credit is a direct commercial real estate lender. We offer creative financing solutions for various asset types, headquartered out of Atlanta, Georgia. Our CPACE team, we provide CPACE capital financing. We work with building owners and real estate developers to provide the financing. To date, we've closed approximately $600 million in CPACE loans, and we've actively financed. I've been doing financing since 2019 in the CPACE arena. Works out to be about an average of 20 CPACE loans per year on average. In Washington, D.C., we've closed $19 million in loans, and I think Ron had just referenced the thread that we financed earlier this year. Next slide. Background on the CPACE tax assessment financing. What is CPACE exactly? It stands for Commercial Property Assessed Clean Energy Financing. It's a state-by-state legislative program. It allows property owners to finance energy efficient improvements on commercial property through an assessment, a tax assessment. The type of commercial property types that CPACE can finance includes hotel, multifamily, senior living projects, student housing, retail, office, and industrial. So pretty much all asset types. By and large, the improvements that can be financed under the CPACE program include, lighting and electrical upgrades, building envelope, HVAC systems, water efficiency equipment, elevators, and then there's an allocation of soft costs for those items that can be financed as well. The next slide shows just the active PACE programs in blue across the United States, while the white indicates that there's not a CPACE enabled program yet in that state. With respect to CPACE loan characteristics, it's a state-by-state legislative program which allows building improvements resulting in utility savings to be funded by private capital and repaid via long-term property tax assessment. The CPACE tax assessments, they rank pari passu or just junior to property tax liens. So they have property they have priority over the existing mortgages and subsequent mortgages. CPACE tax assessments, they're long-term, they're fixed rate, and they're non-recourse. The loan amount typically maxes out between 25 and 35% of LTV, depending upon the program admin guidelines. CPACE tax assessments can extend for periods of up to 30 years, so long as the weighted average useful life of the measures installed exceed the term of the CPACE assessment. And CPACE assessments, I think Ron had mentioned this, they're fully transferable between owners since it's tied to the land. What is our loan process? So it's not unlike any other traditional financing. We go through an initial inquiry where we will look to understand the deal, the capital stack. We'll work with you to obtain construction budgets or pay applications to understand the nature of the improvements that could qualify for PACE for your property. It's important at this stage that we understand who your senior lender is, and if we think, or if you think that they would consent to having the CPACE financing on the property. At that point in time, we'll put together a quote sheet. If the property owner thinks that this is viable for their overall capital stack, we'll actually move to a term sheet. Once we get an executed term sheet and a good faith deposit, then we'll move forward into, kickoff and due diligence. From the borrower side, what is it that we look for in diligence? Typical org charts, org docs, financial information, authorization to run credit, personal financial statements if there's a guarantor for construction financing. Under the property diligence side, we'll obviously look for the property owner to share details about the building, which includes, the site plans and specs. Have you pulled building permits? What does the construction budget look like? And do you have an executed GC contract? We'll review that. Project schedule, construction draw schedule, property operating statements, typically all the things that any traditional lender would review to be able to adequately underwrite your loan. Moving on to third-party reports. The most important, I think, of the third-party reports is truly the engineering report. And this is what we would engage to vet the PACE eligible costs and any savings to investment ratio computations for the program administrator, as Ron had previously referenced. We also check down to make sure there's an appraisal, a phase one, plan and cost review if it's new construction. These things, if we cannot use what's existing, we'll just go ahead and get those ordered. And then from a legal perspective, we will check down title report, property tax bills to make sure that there's been proof of payment for the past 3 years. Is this on a ground lease or is this a fee simple deal? Those are the kind of things from a legal aspect that we'll look to review. And then the loan documents, they're going to be prepared on the program administrator template. Each program administrator throughout the US has their own template loan docs. So we work within those to provide documentation to the property owners. Moving on to closing, we'll close once all the diligence is completed and we've made it through investment committee approval. We obviously have to coordinate the closing with program admin. All the legal docs will get executed. We'll need proof of insurance via insurance certificates. And then, once the project closed, the program administrator or title agent, it kind of depends on what location, they'll actually record the assessment lien to the property via title. The next slide is actually kind of a good illustration of the structure that's put in place at closing with the borrower and the local government. A capital provider closes the loan for the property owner. The property owner completes the project. The local government will record the assessment, and they also bill the CPACE payments, and then they'll remit it back to the capital provider. So you can kind of see it's an iterative process there. And then the last slide just discusses some of the advantages to property owners of using PACE financing. And that concludes the Peachtree Group portion.
All right, thank you, Lisa. Very helpful. So now we're gonna turn it over to Kelly to share her experience from the building owner's perspective.
Great, thanks, Mary. Yeah, so why did we choose to do PACE? I think is the question you guys are probably here to hear about. Urban Atlantic, we are real estate developers. We own about 4,000 units. We've got probably about 1,000 units under construction at the moment, and are generally in the ground up construction business. We certainly have some assets that were acquisition rehabs, but we're developers at our core and multifamily developers. We try to build inclusive mixed income communities, and that's really the core of our organization. So the first time we used PACE, we did this loan many years ago, so things have changed a little bit, but I think it's a nice way to talk illustratively about what the program can do for your project. We have a property called 400 M Street. It is at 400 M Street Southeast in DC, and it's a 139 unit public housing building. It was financed with low-income housing tax credits through the federal tax credit program. It is, so this is a building that is serving a very low-income population, and as PACE came to be in the city, we are always looking for opportunities to help reduce our, especially utility expenses. Utilities are a very large part of any operating budget, and finding savings there impacts the value of your asset. So PACE became available, and we educated ourselves on it and thought it was a really interesting way to finance solar on the roof of this building, which is what we use the funds to do. And the solar is a way for us to both reduce, have a more green building, but also reduce the costs of the utilities to our buildings, and thus passing that on to our tenants, which is always the goal, to support our low income tenants. So this is one of the first PACE loans done with public housing, which I think is an interesting, exciting experience. And so that's why we went with PACE. As Lisa explained, sort of how the process works, you've got a special assessment for your property. The project pays that assessment, and that assessment is then remitted to ultimately your lender. It goes through the administrator, but ultimately you sign documents at closing and say, we authorize you to remit this money right directly to my lender, which my lender appreciates very much because they get paid timely. So that is PACE and what we did on this project. One of the things that we think about when trying to decide what financing structure to use is, how does this benefit the property? How does this achieve our goals as ownership? And what we really liked about PACE is another thing that I think both Lisa and Ronald articulated, is PACE is non-recourse financing. It is long-term, and it is fixed rate. Three things that my investment committee loves to hear when I bring financing options to them. So, it takes the risk off of me as the property owner, and allows the property to pay for these improvements over time. One of the challenging things about deciding which financing mechanism to utilize is, identifying the benefits of it. And with PACE, it's, especially at the time, I think it continues to be a relatively new financing mechanism, is, what does it do for me? How's it better than just going to my, relationship lender? How is it going to help it can help our property. And there's a big learning curve, particularly anytime there is a new financing mechanism. And also, as I think, again, Lisa and Ronald did a good job of articulating, it's very typical from an underwriting perspective to your traditional loans. The benefit is that with a existing financing structure on your property, you're able to put additional leverage on in order to pay for these new improvements. And, assuming your existing lender will allow you to, it primes that mortgage, which, gives the new lender the ability to say, hey, I'm comfortable here because I'm not coming in behind somebody else. And your new lender gets comfortable with it because they can say, hey, I see, we did an extensive energy model that everybody participated in and was shared with all of the various parties. This is going to achieve these savings. And, here's what it's going to look like over the next 10, 15, 20 years based on these energy modelings and the usage and the utility rates and, having the rates increase, but the usage hopefully is decreasing, and all of the various assumptions that go into modeling. It was able to get all of the financing partners comfortable that there was enough cash to pay all of the parties and get them comfortable with where it is. So, we look at PACE as a tool in our toolbox for financing in our capital stack. Got a lot of options, which is good. And in these more challenging environments, understanding and learning about all of your options, I think is, the best way to make sure that you've got the best, you can create and put together the best capital stack for your property to achieve the goals of ownership. So that's what we did it. And we are, we do continue to look at PACE as an option for our properties. We have been looking at it as a way to help maybe add some additional leverage to some adaptive reuse projects that we are looking at, since it can pay for, building envelope, energy upgrades, windows kinds of improvements. And that would be a way where we would, have a senior lender add PACE on top of it to help, at the moment, 50-55% leverage for construction loans definitely doesn't help your IRRs. But adding PACE on top of that can help boost the leverage and the returns to your investors. So those are the kinds of things that we're looking for when we talk about PACE financing.
All right, thanks, Kelly. So we're gonna start off with a few questions that I've prepared. So if the other speakers could come on, and then we'll open it up to the audience in just a few minutes. Yeah, I mean, and I think to some degree, some of these things, this was a very thorough presentation. And first of all, thank you all for the education. So I think we may have touched on some of these topics, but if we could elaborate further, I think that would be helpful for folks. I think, and actually, I think Peggy really mentioned it earlier, was about, the interest in PACE now. So I think maybe this is a question for Lisa or Ronald, but just sort of diving in, could you, speak to the changing position of PACE interest rates relative to market rates and including the mezzanine rates, and what does that do for the rate of PACE loan uptake?
Sure. So, I mean, the interest rates for CPACE tend to be based on treasuries plus a spread. The spread obviously kind of represents, the risk in the deal. So they've been bouncing around a good deal because the treasury, if anyone's been, paying attention over the past couple months, it's gone up and then it's kind of pulled back and it's gone up, and it looks like today it's starting to pull back a little bit, which is good. So it's just kind of been a bit of a volatile, interest rate market. And we're still seeing plenty of interest. But I will say that interest rates are probably between the 7.75 range and up to as high as, probably 9% right now. And I know that sounds high. It's just a function of the treasuries being, 5 or north of 5%, for the past few months. But when you compare to, say, a mezzanine financing or some other kind of financing to help fill the gap that you might have in your capital stack, we tend to be, I'd say PACE is a good 300 to almost 400 basis points less costly, and in some instances more, more beneficial. So there's still wide acceptance for CPACE financing. But again, it's tighter than it used to be on the interest rate side.
Ronald or Kelly, do you have anything to add?
No, Lisa covered it. I spoke, to the comparative rates when, comparing mezzanine financing. And like I said, we are just seeing a lot of activity, in the past year. As I mentioned, when we look at the program being created 10 years ago, and we did 48 million within 1 year, a little over a year, the activity has just ballooned in the PACE program. And we're sitting, even though I say that our statutory limit is $250 million, I'm currently sitting on a backlog of $250 million, which is a good problem. So there's a lot of interest in PACE, and I'm hoping that at some point, if we happen to reach the $250 million mark, that the powers to be will increase that limit, because it's certainly proving beneficial to the district.
Okay, thank you. One of the questions that we actually received with registration was specifically about Fannie and Freddie. And the question was, will Fannie and Freddie accept PACE financing on existing deals? And I'd like to sort of expand the question to, HUD or USDA, other federal programs, and how that they interact with PACE.
Yeah, currently Freddie and Fannie do not participate with us. However, HUD does, and we did a HUD deal, I believe, in 2017 or 2018. So they recognize it. A lot more requests have from PACE lenders have requested support from HUD, and HUD now is very open to backing, working with the PACE program in doing HUD deals.
And then with respect to USDA, we've closed a couple PACE loans where in the senior position, the senior lender had a participated interest with the USDA. So there's participation there.
All right, thank you. I think it would also be helpful just, and this is a good example of, we've touched on it throughout, but if there was sort of a consolidated list of potential snags or potential pitfalls that PACE applicants should be looking out for. I mean, what, and this is a question for all three of you, what might that be?
Well, we kind of spoke to senior lender consent. I mean, if you have a senior lender, it's important to know that they will, consent to this financing. obviously, because we absolutely cannot close, and no program administrator will allow you to close without actually having that written consent in hand. I think from trying to get your CPACE eligible costs to qualify, right? At or above code, try to, if you've got above code, that's going to bode well, a little better for you than at code. And again, every program administration group across the country is a little different, how they view that. But, the more energy efficient your improvements are, the better off, you'll be as far as qualifying and getting, achieving that savings to investment ratio, that SIR calculation that Ron mentioned earlier in his presentation.
I would add that this is where relationships are going to come into play huge, right? This is where that education and relationships comes in. You want to have, if you're thinking about doing this, you want to have the conversations with, the Ronalds and Lisas, but you also want to talk to your existing lender and have those conversations with your existing lender and sort of feel out where they are and educate them the best that you can to bring them along with you, right? Because the reality is that's probably where you're going to get the most resistance. And generally speaking, at least in my experience, resistance is usually because they just don't understand the program very well. And so as an owner, I have found that 90% of my job is just educating people and helping bring them along. And so I think that's a big piece of the puzzle is that education process. I don't think that can be underemphasized, like how important that piece of it is.
I agree with that as a former lender.
All right. My last question before opening it up to the audience is, what other resources are there out there to help folks understand PACE in the DC area and broadly?
I mean, I would say you could kind of seek out in any one of the states where PACE has been enabled, who the program administrator group might be, and they'll have a website, they'll have a packet with checklists of what it is that they're looking for projects that qualify under their program.
Yeah, I think the thing with in our jurisdiction, because you're dealing with multiple usually jurisdictions, there is also a lot of information on various websites to sort of start that process, and then I think reaching out and talking to the individuals who are in charge, because they are your best source of information.
And I'm always available to talk and speak with anyone that has a question about PACE. So, yeah.
And here's Ron's email address. Okay, well, I'm gonna stop sharing my slides, but these slides, they will be available. So Peggy and Cynthia, you all can distribute them, so you'll have our contact information in these slides. But I'll stop sharing, and if everyone wants to come on camera, or whoever wants to come on camera, we will open it up to audience Q&A. And if no one has questions, I have a few more, or Peggy, I know you have some questions, so if you wanted to ask, that's also welcome.
Well, I just know that in your pro forma, Kelly, when you projecting out, I think Ron said, be sure to project out what you expect your energy usage to be after the renovations are done, retrofits are done. A little bit more difficult is to project out what the utility rates will be, because you don't have really control over that. Looking back, since you now have some history from when you obtained your PACE loan, you made some assumptions. How's that working out? Are the assumptions staying, are they playing out the way you thought they would?
Well, for all modeling that we do, I always joke that it's going to be wrong. And it's
How
what,
wrong?
yeah, it's never correct. It's never 100% right. It's why the sensitivities are really important and making sure that you understand. And I think the best that you can do is look at sort of history and what rates have done. And look forward. I think you certainly can read about utility pricing going up. I think that everyone is concerned about that, personally as well as professionally for our owners. And you just have to kind of do the best that you can and work with, we certainly worked with consultants that helped us with our energy modeling and, people who are in that business and in that space on a regular basis, that can sort of look to, we can look to our portfolio, but they have access to, much more information than we do, and using the best you can. That's all you can do. But yeah, I would say that as a general rule, rates have gone up faster than we anticipated. And you just kind of have to, we're not terribly far off, but we did not project rates increasing as much as they have.
Right. So I guess my point is, like, when we talk about the advantages of PACE financing, at least in the early days, it was promoted as a way to pay back the loan with the savings you would achieve through your utilities usage. And that's not exactly playing out the way maybe you thought it would.
It hasn't played out exactly how we hoped it would, but I think that, it's still, we are better off than we would have been.
Sure.
Right?
Oh, yes.
I think that's the part that's hard to think about in this scenario, right? Which, like, if we hadn't done those improvements, our energy costs would be even higher than they are today. And so while, what we had originally anticipated didn't work out exactly right, we are still better off than we would have been had we not done the improvements. And so, I think that's the part where you have to kind of make that comparison, right? When you go and you say, hey, how did this turn out? And you do your postmortem many years later, you're not comparing to like the model, you're comparing to what would we have been.
Absolutely. I guess my point, that's absolutely the case. We intervene in utility rate cases on behalf of our members, and that's our line. Things would be worse, but for our participation. So I totally get that. What I'm saying is that if you are dependent on the cash flow from that line item in your operating statement, you have to get it from somewhere else if costs are exceeding what your projections were. So it's just something, as you said, to keep in mind when you're thinking about the payback mechanisms.
That's right. And I think, from our perspective, what we try to do is just make sure there's enough cushion to cover that, right?
Right.
It's why I think, I don't remember if it was Ron or at least the slide, but they underwrite to a 1.2 coverage, right?
Yeah, 1.2, right.
That's your cushion. And hopefully, you're kind of within that range. But right. Yes, it is one of the risks that you take as the borrower.
As a follow-up question, this has to do with the banks that are participating. I have heard that with some, this is on the office building side, with some buildings looking to give the keys back to the banks, but still the property is not exempt from local building energy performance standards. And this I heard in the context of the New York regulatory scheme, that banks that previously were not inclined to give up their priority lien status are doing so because they don't want the keys back. They want, they would like the current property management company or owner to do the compliance with the local regulations and avoid a penalty that then would just add insult to injury when if the loan needed to go back to, the building needed to go back to the bank. They don't want to be in the business of having to get into compliance, is what I'm hearing. Have you heard anything similar? But that's sort of a reality of what's happening today with receiverships.
I have not heard anything in that.
Okay.
Yeah, and I'm on the hub side, we haven't heard that either. But that's definitely the kind of information that we are trying to stay on top of and, see how that can be addressed.
And Ron, you mentioned that you would like to be in the position of having uptake on the full 250 that you have authorization to approve. What would be the process? Is that a legislative request?
Yes, yes, it is. We would have to queue that up with one of the subcommittees and present our case to the subcommittee. I think it's Department of Transportation and Energy. And we would, present why PACE has been beneficial to the city. And keep in mind that with this being a public-private partnership, the district has zero liability
Right.
in this program.
There's no risk for them. They're just
Right.
a pass-through mechanism, as you explained to us.
It's a pass-through for collection, yes.
Well, thank you so much to everyone. Very informative. And for those who have participated, we will be able to give you the slide deck, as Mary mentioned. And we did record this. So if you need to listen to it again, you can do that too. But I thought it was very well organized and clear, very professional, very valuable. Can't thank you enough for putting it all together. Thank you.